Welcome to Casense.
For a long time, the business world has operated under a stubborn assumption. If a company decides to launch a new environmental or social initiative, executives often brace themselves to see their profit step. There is a lingering belief that doing good is a zero-sum game. The logic goes that every dollar spent on a sustainability project is simply a dollar subtracted directly from the bank account. But recent data tells a different story. Research from Harvard and McKinsey shows that companies that actively tackle specific environmental and social issues actually outperform their competitors financially. This outperformance comes down to a concept called the Materiality-to-Value Linkage. This approach relies on focusing exclusively on the specific issues, the material ones, that directly interact with a company's daily operations. In plain English, this means doing the math. It is the process of drawing a proven, measurable line from a specific sustainability effort right to the money it either saves or generates for the business. When a company identifies which issues actually impact their bottom line, they can begin to treat sustainability as a core part of their operational strategy. To see how this works in practice, we can look at this four-stage mechanical diagram. Think of it as a chain reaction that transforms an abstract environmental or social problem into concrete financial value. Step 1 is identifying the material issue. A business cannot fix everything, so they have to filter out the noise and select only the topics that genuinely impact their specific industry and the people they serve. Step 2 is taking action. Once that core issue is identified, the company has to physically address it in their strategy or daily operations. That might mean finding ways to use less water in a factory or designing a greener product. That action triggers Step 3, moving a value driver. McKinsey research identifies 5 main levers here: increasing total sales, saving on costs, reducing legal risks, making employees more productive, or making smarter investments. Finally, we reach Step 4, financial value. When you pull one of those levers, the result shows up directly on the balance sheet as measurable gains. This 4-step framework removes the guesswork from corporate responsibility. It turns vague goodwill into a precise equation for financial performance. Let's look at how an apparel firm called Brightwear puts this into practice. Originally, the Brightwear board of directors viewed all environmental and social initiatives as a heavy drain on their profits. This flowchart maps out exactly how Brightwear used their data. First, they identified heavy water use as a critical issue for clothing manufacturing. Then, they took action by upgrading their equipment to cut factory water waste. By cutting that water waste, they directly lowered their monthly utility and raw material bills. Those cost savings led directly to a higher profit margin. They applied the exact same logic to worker safety. By improving conditions on the factory floor, they reduced work stoppages. That made the factory more productive, which saved the company money. Finally, they took this credible sustainability effort and shared it with the market. That won over eco-conscious retailers, increasing their total sales. By connecting environmental and safety efforts to clear value drivers, Brightwear showed the board that these initiatives directly improved the company's financial performance. This linkage is a useful tool when you are building a new corporate strategy, communicating value to investors, or trying to decide which sustainability issues to prioritize first. However, it requires strict discipline. Applying this framework incorrectly or dishonestly can damage a business's credibility. One mistake is making vague claims. Stating that sustainability creates value without actually tracking the data and mapping the exact chain of events is ineffective. You need the numbers to back it up. Another pitfall is a lack of focus. Companies often struggle when they chase every single trending environmental issue instead of focusing on the specific topics that actually impact their industry. You also have to avoid forcing a financial connection where one doesn't exist. Sometimes a business has a genuine social impact that matters to the community, even if it lacks an immediate financial payoff. Most importantly, this framework is not a tool for greenwashing. You cannot dress up empty public relations claims with fake metrics. Rigorous data tracking and total intellectual honesty are what separate a compelling business case from an empty marketing campaign. The reality of business is that not every single environmental or social issue will move the needle for a company. But if a company focuses on the specific issues that matter to its operations and traces a carefully measured line to a real value driver, sustainability can become a significant competitive advantage. Treat sustainability as an investment in the way you operate. Focus on what actually matters and follow the money.